Hey everyone, welcome back to Corporate Decoder, the place where we unpack the money moves of the biggest companies. And today we're diving into Community Financial System Incorporated's latest annual report, a deep dive into their financial health for the year ending the 31st of December 2025. This is a big one, folks, packed with numbers that tell a story about not just how much money they made, but how they plan to keep making it and the risks they're navigating. We're going to cut through the jargon and get to what really matters. Before we dive in, if you love getting these straightforward insights from SEC filings, make sure you hit that subscribe button and ring the notification bell. Also join our growing community on Discord, linked in the description below for even more exclusive content and discussions. Alright, let's get started with Community Financial System Incorporated. This report is a window into their operations for the year ending the 31st of December 2025. First up, let's peek at their financial position reflected in the consolidated statements of condition. At the end of 2025, their total assets stood at a hefty $17.3 billion, a solid increase from just over $16.3 billion in 2024. This growth is driven by a few key areas, notably loans, which saw a substantial rise. Gross loans outstanding hit just under $11 billion at the end of 2025, a significant jump from about $10.4 billion the previous year. That is a 5% increase, reflecting strong lending activity. This growth is a mix of what they call organic expansion, meaning they're making more loans themselves and also picking up loans from acquisitions, particularly from Santander Bank, NA. Now let's talk about the engine room of any bank net interest income. Their net interest income for 2025 was a robust $506.6 million. This is up a solid 12.8% from the prior year. What does that mean in simpler terms? It means the difference between what they earned on loans and investments and what they paid out on deposits and borrowings was wider and more profitable. They chalked this up to higher interest earned on their loans and lower costs for their funding like deposits. This marks their 19th consecutive year of net interest income growth, which is quite impressive, showing consistent performance. Now let's look at their non-interest revenues, which come from fees and services. They reported $311.5 million in non-interest revenues for 2025. That is up 4.8% from last year, and they are celebrating record results across all four of their operating segments: banking and corporate employee benefit services, insurance services, and wealth management services. This diversification is a key strength, but of course running a business costs money. Their non-interest expenses increased to $521.3 million in 2025. This is about a 7.1% increase. Management points to a few things here, including acquisition expenses, notably from the Santander branch deal, costing them about $3.7 million, and some restructuring expenses for workforce optimization totaling $1.5 million. These are time costs, but they also saw increases in regular operating costs like salaries, employee benefits, and technology investments. How does all this translate to shareholder value? Let's look at their return on average equity, a key profitability metric. For 2025, it was 11.29%, up from 10.76% in the previous year. This shows they are generating more profit relative to the equity shareholders have invested in the company. Even their operating return on average equity, a non-GAAP measure that strips out those one-time costs, was even better, at 12.07%, showing strong core profitability. Now, for any financial institution, the allowance for credit losses is super important. It is their estimate of how much they might lose from loans that might not get paid back. As of the end of 2025, this allowance stood at $87.9 million, an increase from about $79.1 million the year before. This increase reflects their loan growth and a precautionary reserve added due to some larger business lending exposures. They manage their provision for credit losses, which is the expense they record for potential losses, at $21.4 million for 2025, a slight decrease from 2024, indicating stable credit quality metrics overall. Moving into how they manage their operations and risks, let's look at their internal controls. Management concluded that their internal control over financial reporting was effective as of the 31st of December 2025. That is good because it means they have systems in place designed to ensure their financial reporting is reliable. The independent auditors PricewaterhouseCoopers LLP also agreed with this assessment. One area that required significant judgment and therefore was highlighted as a critical audit matter was the allowance for credit losses, particularly the qualitative adjustments. Management has to make educated guesses about future economic conditions like unemployment and property values. They use different scenarios to estimate potential losses, and their auditors put a lot of effort into checking these judgments. This shows how much careful estimation goes into these numbers. Let's talk about recent growth. On the 7th of November 2025, they completed a significant acquisition of 7 branch locations from Santander Bank. Now, this deal added $31.9 million in loans and over $543 million in deposits to Community Financial System Incorporated. They paid $80.9 million for this and recorded core deposit intangibles and goodwill, reflecting the value of those customer relationships and future earnings potential. Looking at how they incentivize their people, the company has various stock-based compensation plans. As of the 31st of December 2025, they had over 2 million securities available for future issuance under their equity compensation plans. This shows a commitment to aligning employee interests with shareholder value. Back to profitability, their net interest margin for the full year 2025 was 3.29%, which is an improvement from 3.04% in 2024 and 3.11% in 2023. This higher margin means they are earning more on their loans and investments relative to their funding costs, a positive trend. Now let's touch on liquidity given the recent banking environment. At the end of 2025, their sources of liquidity, including cash and borrowing capacity, was $6.8 billion. This is quite healthy, exceeding their estimated uninsured deposits, which were around $2.7 billion. This suggests they have a strong buffer to handle potential deposit outflows, which is crucial for stability. The story here is one of quiet strength and consistent growth. Community Financial System Incorporated is not making huge leaps, but is steadily improving its financial performance. They are effectively managing their interest rate, spread their loan and deposit growth appears healthy, and their diversified business model across banking, employee benefits, insurance, and wealth management provides stability. The risk factors section does highlight significant concerns around interest rate changes and liquidity pressures common in the banking sector, but their own numbers suggest they are well prepared. The Santander acquisition looks like a smart move to expand their presence in a strategic market and their continued investment in technology, and people points to a forward-looking strategy. While the increasing cost of non-interest expenses is something to watch, they seem to be stemming that tide with revenue growth and efficiency improvements. Overall, Community Financial System Incorporated appears to be a well-managed company with a solid financial foundation and a clear strategy for continued growth. They are demonstrating resilience in a challenging economic environment. So what is your take on these numbers and what they signal for the company's future? Let me know in the comments below. If this deep dive was valuable, hitting that like button really helps, and subscribe for more corporate breakdowns just like this. Don't forget to join our Discord community, linked in the description, for more discussions and exclusive content. Thanks for watching. See you next time.